So interest rates just went up in Canada again just last week, October 26th, and there's really no sign of it slowing down. So on that day, they went up just by 50 basis points, which was below what the markets and the analysts were predicting. So we did not see very volatile day that day. In fact, I think by the end of that week, the TSX went up by 1 or 2%. I personally held off on buying any stocks that day because I've been burned before back in July when the basis points went up by 100. That was an increase that no one saw coming or didn't think was actually going to happen because it was such an increase, where I bought some stocks in the morning and then the interest rates report came out, or just the announcement. And yeah, things dropped, and I didn't like lose money because I didn't sell anything, but I probably could have bought those stocks at a lower price. So then again, it was in September when the next increase was happened, and again I kind of just held off. That time things went up by 75 basis points, which again is very high, but this time I think the market was okay with it because then there didn't seem to be that many waves that generated out of this. So why am I saying all this? Why am I telling you all this? Clearly it influenced me when I was going to buy my stocks, but it does affect the markets. And so it's something I think it's important for us to be aware of. So I'm going to tell you the next two dates that are coming up that you should write down and keep in mind so when you're buying stuff. So let's talk about that coming up. How's it going, everybody? I hope you and your investments are doing well. My name is Steve, and I'm a dividend stock investor. And like I said, I held off on buying some stocks last week until I knew what was going to happen after the interest rate report came out. And afterwards, then once things were kind of fine, no crazy swings, I picked up some additional Corus Entertainment. I know, and people are probably typing in the comments right now, that this looks very much like trying to time the market, where it is and it isn't. I think what it really is taking some basically scheduled information that we know is going to happen and where we know it influences the markets, and just taking that in consideration when we are trying to time our purchases. So I put $150 every week into my tax-free savings account. The money gets dropped on a Wednesday, and it just coincided with the last increase of the interest rates. So if I bought stocks on a Wednesday versus a Thursday, which I ended up doing, I'm still putting money in. So it's not so much timing the market. It's just kind of just waiting to see what happens, with the markets, and then making the best decision. But you need to know when the dates are. You need to be aware that these things are happening. And that's why we're going to talk about that in this video. And so the first one is coming up, and that's for the Consumer Price Index, and that's on the date of November 16th. So the Consumer Price Index is what they use to measure the Canadian experience as they're buying things. How are prices going up or down? Where are the increases? Where are things decreasing? So how is it impacting the Canadian consumer to really get a good measurement of inflation? And there's 8 things that they look at, and those 8 things are food, shelter, household operations, furnishing and equipment, clothing and footwear, transportation, health and personal care, recreation, education and reading, and alcohol beverages, tobacco products, and recreational cannabis. So the September report that came out in October, because it's always a month behind, showed at the 12-month year over year that the inflation was around 6.9%. So now that's down from a high of I think it was 8.1 or 8.2 just 2-3 months ago in the summertime. So it looks like inflation is on its way down, but we won't really know if that trend is continuing until we see the October numbers coming up in November. How this then influences the stock market is that it's one of the first earlier indicators of what is going to happen on the interest rate. If inflation seems to be going up, the Bank of Canada might need to do something a little bit more severe to get our inflation rate back down to around 2%, which is their their target, which is like that's what they're obligated, that's their mandate to do to kind of normalize consumer spending at 2%. So if the consumer price index is really high, then there's a lot more work that needs to be done. So therefore, that price, the increase in basis points might be higher. Maybe it might be 75 versus 50 this last time. Maybe it might be 100 to kind of really shock the system to help curb consumer spending and to get the inflation rate lower. So the Bank of Canada takes that information and then they look at also how much production, how much selling, how much are consumers still buying things at those prices to kind of really determine what those increases are going to be. And the next increase that they're going to announce is on December 7th. And already the Bank of Canada is letting us know that it could be another high one. The predictions were around the 50 basis points, but the Bank of Canada was talking this week and it's looking like maybe it might be more around the 75 basis points mark. They are really trying to glutton the interest rate, the inflation rate. They are going to do everything they possibly can to get it back to 2%. According to the Bank of Canada, the consumer price index inflation is projected to move down to about 3% by the end of 2023 and return to a 2% target by the end of 2024. So us as investors, we've got a long ride of these inflation and interest rates going all over the place. So this is quite an interesting time to be investing. Now, these interest rate hikes can influence us as investors in a number of different ways. And so here's the two that I've personally have experienced. And the first one is a little bit of hesitancy, not long, but like I mentioned in the beginning of the video, I held off making some purchases on the day that the interest rate was going up because I wanted to see how it really influenced the market. I was waiting to see if it was influenced in my favor because I'd rather buy some stocks when they're down so that way I can improve my dollar cost averaging. But it just did create some hesitancy, which is not good because, again, I fully agree with all of us that, it's time in the market, not trying to time the market. But again, this is a little micro timing. So I'm not holding off my money forever. I'm putting my money in every week, but it still creates some hesitancy, makes you kind of pause and go, what should I do? Should I do it now? Should I do it tomorrow? Should I wait another week? But no, consistency is the name of the game. But the other way that it has influenced me with my purchasing of stocks, ETFs, and this is the point where I should make note that, this is not personal finance advice. This video is for entertainment purposes only. And what works for me might not work for you. So take what I'm about to say with a grain of salt. But because the interest rates have gone up so much in my RRSP account where I hold bonds, I have not put much money into bonds lately because the inverse relationship that they have with interest rates. So the bond prices have gone down quite a lot, which has really dropped my account quite a bit because the interest rates are going up, which really this should be the time when I should be buying more bonds. But because everything has kind of gone down, I'm still at this nice diversification where bonds makes up, I believe it's 15% of my overall portfolio, but just the value is just gone down. So I'm holding off on buying additional bonds because if the interest rates keep going up, the bond prices are going to keep going down. So I would rather wait till they do bottom out a bit. And again, this is where it's like, oh my gosh, Steve, you're talking about timing the market. Yes, and yes, I guess I'm timing when I buy certain asset classes is really maybe what I'm doing. Is that timing the market? Leave me a note in the comments. Am I breaking the cardinal rule of not timing the markets? I find myself struggling with this. So any advice you give me is worth gold, which that's down to. Gold is down to. So, but here I find myself not wanting to buy bonds because the interest rates are going up. So it's like, it's probably be a smart move to kind of wait till those interest rates have gone up as high as they possibly can before they start going down, and then swoop in and start buying some bonds at some low prices. That is how it has influenced me. So these two dates, the consumer price index the interest rates increases. So it'll be the last one for the year, thank goodness. Keep those dates in mind as you're kind of planning what you're going to be doing, and just being aware, like when you're checking the markets that day and suddenly something dramatic really happens, at least you then know why it happened, which then knowledge, that is power. Regardless of what I do, regardless of what you do, these are very interesting times to be investing. And I think we're going through a little bit of history here where record inflation, interest rates going up, recession coming up. It's just a very, very strange mix. I don't think we've seen anything like this before. Boy, oh boy, I'm glad that we're here together on this journey. I hope you found this information helpful, knowing those two dates as we finish out the end of 2022. Don't forget to hit the like button, subscribe if you haven't already. I'm very close to hitting a specific milestone, so you know what? Help me get over that little hump. That'd be appreciated. So I'll take this opportunity to thank all of the current subscribers. I love you. You're amazing. So with that said, keep it in the green. We'll see you in the next video, and we'll talk to you later. Bye.